Hello and welcome to today's webinar. My name is Igor Zuckerman. I'm a President and Chief Investment Officer of Passpon Advisors. And today we'll be talking about a market update. We'll be talking about the first 3 quarters of this year, what's been going on, what worked, and then we will look at the upcoming Q4, actually the one that started already, and we'll see what is likely to work and what to watch out for, the market drivers and risks. And I will leave the last few minutes for questions. If you have questions during the presentation, feel free to just type them in. I will see them, and I will try to address all of them at the end of the presentation. So as we are starting, before we take a look at what's been going on this year, I just wanted to do a quick poll to see what people think has been doing well this year. So these are your 5 choices. Please don't cheat, don't Google it. Just say what you think is right. Which one of these assets had the best performance year to date between U.S. equities, developed equities, emerging markets, high yield bonds, and commodities. And we'll dive right into it right after we're done with the poll. I have about 30 seconds left in this poll, and I will use them to give you a quick disclaimer. We'll be mentioning a number of different investments during this presentation. They do not constitute a recommendation to buy or sell. This is important because obviously these recommendations should be personalized and not generalized. And we also have clients. Passpon Advisors is the advisory company. We have clients, and some of the investments mentioned in here in this presentation may be used for client accounts. You'll find more in terms of disclaimers at the end of the presentation, but this is just a compliance required disclaimer. Also keep in mind that the future results are not guaranteed by past performance, which is a play on words on today's title of the presentation. All right, so we are done with voting. So the majority, 37%, is split between U.S. equities and emerging markets equities. Well, actually, U.S. equities are now higher. All right, so without further ado, let's dive right into it. So what you're looking at is the review so far, year-to-date review. These are major asset classes. By the way, these screenshots are from our website, from Passpon Advisors. We have a market monitor, and we use ETFs as proxies pretty much for most asset classes and sectors that we will be discussing. So this is what it looks like. You can always go to www.pasponadvisors.com/markets, and you would find this market data there. So what you can see, these are the major asset classes. The rightmost column is the year-to-date column, and this is as of close yesterday, I believe, the 16th. So you can see that number one that's highlighted in a lighter green is emerging markets, up some 33% this year. Frontier markets is close by with 28%. International small caps, 26%. And then you can see that U.S. total Uh, Stock market is up roughly 14%. Large caps actually doing better than mid caps and small caps. Um, but so this is the answer. Those who got emerging markets equity, they got the right answer. What's also interesting is that it's a pretty impressive risk-on rally, so to speak. So the risk assets have been vastly outperforming uh, less risky assets, safer assets, and essentially only a few asset classes are down so far on the year. Those are oil, notably, um, commodities overall, and the US dollar, which may be surprising also to many. US dollar as a basket against other currencies is down quite a bit on the year. And volatility, I mean, that's a separate case. Most people consider that a separate asset class these days. Um, Equity volatility in U.S. markets has absolutely tumbled so far this year, and we'll talk about this in a little bit. So let's take a look at global equities now. Again, these are um, regions and countries represented again by U.S. ETFs that are proxies for each one of these countries and regions. What's interesting is that in the Americas, you can see Latin America has done very well, especially Chile, Peru, Brazil, Argentina, all up 25% and more up to 40%. Canada is the laggard in this area, which is still up 12%, close to the U.S. By the way, I apologize for the possible confusion with the color. The orange color in year to date designates the lowest, the poorest performance within this group, but you can see it's still positive. So within EMEA, again, a lot of green. As you can see, Austria in Western Europe has been outperforming. If anybody gets that, that's kudos to you. Poland overall in Europe is up some 52%, which is quite remarkable. Overall, you can see that the Eurozone is up 26% on the year, with major components around there. UK is lagging a little bit, but it's still up 15% on the year, even though Brexit is still looming. Essentially, in this entire EMEA region, the only down component is Turkey. And Asia Pacific is doing even better than EMEA. Again, most of it is emerging markets. Japan is the one in this whole region that is lagging. Again, it's up 11% on the year, not too shabby, but it's the worst in the region. So if you look in China, depending on which China index you look at, it's up some 30 to up to 48%. And just about everything across, even a place like South Korea, with everything that's going on in North Korea, is up nearly 37% on the year. So moving on, global bonds. Again, even bonds, for the most part, have been moving higher. Majority of what you see on the left side is different U.S. bonds. Again, convertible bonds, the ones that closest to equities and therefore the riskiest, is leading overall this category. But even the high grade bonds are doing pretty well. The only thing that's flat or even down is a very short end of the curve. And if you look at foreign bonds, they are doing pretty well. In fact, inflation bonds have been doing pretty well on the international front. I've included this other chart on the right side. These are not ETFs. These are individual 2-year government bonds across Europe. The reason you're looking at this chart is because it was unthinkable, unimaginable just a few years ago to see the yields on these bonds negative. You can see this across basically the entire Western Europe. 2-year bond is negative, which means people who are buying the bonds today are basically expecting negative yield going to maturity. Add to that the second column, which is the inflation in each respective country, and the real yield is really negative. We're looking at almost 3% in some of the places. This is the state of affairs that we have in the low rate environment today. Many investors and institutional investors are buying the bonds to effectively lose money. But this is the low rate environment that we live in. We'll talk a little bit more about that going forward. Continuing with the review on the next slide, commodities and FX. So commodities has been a story essentially of a tale of two types of commodities, if you will. Oil and gas have been absolutely decimated so far this year, especially the natural gas, down some 30%. Same goes for all the soft commodities. Anything agriculture-wise is down quite a bit on the year. In fact, sugar of all the commodities is performing the worst. And on the other side, the metals have been doing really well. Precious metals led by palladium, and base metals led by copper are doing pretty well. And on the right side, you have FX. These are pairs with the dollar, and on the bottom you can see the basket, the dollar basket against I believe it's 16 major currencies. So you can see how much down it is against the major currencies. Euro has done really well against the dollar so far, and pound has rebounded from last year's lows after the Brexit vote. Perhaps also the Mexican peso is interesting, that the dollar is down 8.5% against the peso, even with the Trump's rhetoric after the election, where many were expecting the Mexican peso to be under fire. All right, and so now we can take a look specifically at U.S. sectors. These are major U.S. sectors, again with proxies by tickers, and you can see that so far this year, technology has been leading the charge. If you were paying attention to the market, obviously that's no news to you. It's followed by healthcare, and also industrials and financials have been doing pretty well, and consumer discretionary. Materials have been pretty much flat on the year, and the one big loser is energy. Again, this is highly correlated to what's going on with the underlying commodities that we just looked at. Oil and natural gas have been very poor performers, and therefore it's no surprise that energy is down this much so far this year. Now, I've also included this graph. So in addition to sectors, obviously there are pockets within the market that are doing even better than any individual slice of the market or a sector. Um, so just to give you an idea, what's actually been working so far this year. These are example of ETFs that are outperforming and underperforming. In fact, this includes some of the best year-to-date ETFs and worst year-to-date ETFs in the US. On the left side in green, these are the ones that are up. So ARC Innovation ETF, if you've never heard of it, don't be alarmed. Most people would probably be in your shoes. This is a relatively small ETF by ARC investment company. They specialize in thematic ETFs and they're actively managed. So this particular ETF deals with overall innovation, and one of only two ETFs, and the other ETF is also by ARC, that has exposure to Bitcoin. And I'm sure if you heard that, that would probably explain why it's up some 70% on the year. The other one that's rivaling in performance is the China Internet ETF. The ticker is KWEB. So these are literally the two best ETFs so far this year. I've included a couple of others that are a little more mainstream. They've done well, but they're nowhere close to being, let's say, top 10. These are the semiconductor ETF, SOX, and the biotech ETF, XBY. These are there are more semiconductor and biotech ETFs. These are just for illustration purposes, taking the largest, the most liquid in those two areas. And on the right, we have the three biggest losers. The U.S. Natural Gas Fund, again, since the underlying commodity has been underperforming, it's no surprise that the equity has been as well. The PowerShare Small Cap Energy portfolio, again, there's a number of smaller energy companies that are on the brink of going out of business, or have already gone out of business recently. So that's another area where there's been a lot of red ink. And on the same topic, oil and gas equipment and services ETF has been another disappointment this year, basically for the same reasons. So that's the major asset classes, and let's take a look at what precipitated all of that. First of all, let's talk about volatility. So this year has been unprecedented with the low volatility. I'm presenting you with these two different charts. The first chart has annual volatility graphed as a bar. So the red dot is the lowest point of the volatility throughout the year. The green is the highest, and the blue is the mean. And as you can see, going as far back as the 90s, there's nothing quite like 2017, which is the rightmost bar. You can obviously see the 2008 being the financial crisis with a huge spike in volatility. But in terms of the low volatility, 2006 and maybe 96 may come close, but nothing actually hits the current points, the current low points as well. And the right chart shows you the lowest average monthly volatility. So this is average by month, and as you can see, the October of 2017 so far is literally the lowest average volatility for the month on record. Well, what does that mean? Many people consider this to be a complacency of the markets, but many people, many other people believe that this is just what precipitates the rally and why we keep seeing higher closes in U.S. markets and around the world all the time. Well, can this rally continue? There are a number of different ways to look at the market to see where we are and whether this is sustainable. So this chart looks at a technical indicator called RSI, which is the relative strength index, which is used often by market participants to gauge whether a security or an index in this case is overbought or oversold. For those who are not familiar with it, this is basically a number between 0 and 100, with 50 being neutral. And typically this number over 70 would represent an overbought condition. So this graph that goes back a couple of years shows you the graph of S&P 500 daily closes, and on the top you can see the RSI, the index, the relative strength index, with the number 70 and 30. These are the two numbers representing overbought and oversold, respectively, and you can see that RSI is usually within this channel. In a couple of places it goes over, and it is over 70 right now. In fact, it's 72 and change. So by that measure, it's the market is overbought, and usually you can see that as RSI dips, it causes a little bit of a back trace by the index as well. So this is one of the indicators, one of the few technical indicators that I personally would use to look at what's going on with the market. Another viewpoint is fundamental valuations of the U.S. Equities. So price to earnings ratio is usually the one that's being quoted the most, but based on many analyst opinions, price to sales may be a better measure, a more fair measure of the valuation of the market. It's much harder to manipulate price to sales than price to earnings. And price to sales, as you can see from this graph, that's a historical graph going back some 30 years. We are approaching the valuation of the 1999 high, and you'll remember where that had it, and you can actually see it on the graph. So again, another cautionary tale. The markets are not cheap. In fact, there was a recent survey of market participants asking them whether they think in Q4 the markets will go higher and whether the markets are cheap. 79% of the respondents said that the markets are going higher. 0 said that the markets are cheap. As we said in our recent newsletter to our clients, if this is the only thing you need to know about the market, that's basically it. There's a powerful uptrend, but the markets are expensive. So moving on, one other data point that we should mention here is the stock flows, especially the retail, the investor stock flows. This may also be a surprise. I know it was a surprise when I first saw this chart on the left. Sometime around March, the overall flows into U.S. ETFs and mutual funds started declining. Now, you may have seen some headlines that are basically saying that the ETF inflows are at a record high. And that is true. These are ETFs specifically, and not just US equity ETFs, it's just overall ETF market. We're talking about investor flows into US equity that are done through equity ETFs and equity mutual funds. The combination of those two has been on a steady decline since roughly March. Also, if you look on the graph on the right, the percentage of US households that are investing in stocks, this goes by year from about 99. The highest was in 2007. As you can see, after the financial crisis, that number has gone down. It started rebounding just around 2013, and perhaps that has something to do with the rise of robo-advisors. I did a presentation last month on robo-advisors. If you're interested, you can look that up. That's probably contributing to this increase here. But again, if you look at this last year, the percentage of US households that are investing in US stocks has been decreasing. This may be perplexing because this is the type of rally that we've been having in US equities. People don't like it. It's an unloved rally, and yet it keeps going up. So unlike potentially 1999, there is no euphoria. There is not the exuberance that was happening back then, and therefore a lot of market analysts believe that the rally still has legs, that the trend continues until it's broken, and a lot of money, especially retail investors, their money is still on the sideline. So, moving on to market drivers and risks. So, what should we look at in Q4 and potentially in subsequent quarters? What will drive the markets, not just in US but globally, and what should you watch out for? Well, number one is corporate earnings. It's interesting that a lot of investors often forget that this is really the number one reason that drives the markets. This is, after all, what equity investment is. You're hoping to see growth in earnings, and if you believe that's going to happen, you buy into the equity. You want a share of that growth. So corporate earnings are paramount, and the Q3 reporting is basically underway in US, and what's going to be reported and how the companies will guide for the next quarter, next year, will most likely drive the direction of US markets more so than any other factors. Economic data and central bank actions, obviously this is also a very important topic, and that influences the equities and equity prices. Inflation, there's a reason why each one of these has a question mark next to it, because there are a lot of questions in economic data that are still sort of in flux. Employment, or rather unemployment, and this goes not just for the US but for all global regions, and of course rising rates. So the basic assumption at this point is that the easy money policy is essentially coming to an end. The rates will rise. The question is only when and by how much. If anybody tells you they know that exactly, just run from them. Don't even walk away, just run away. Nobody really knows. The expectation in December is that there is a likelihood of a pretty high likelihood of a rate rise in the U.S. But even that is not certain, and anything that goes beyond it is also uncertain. And in fact, who's going to be the Fed chairman next year is also a big question mark, and how the policy is going to change. And same in terms of policy goes to some degree for other major markets, including Europe and UK and Japan. The rates are still very low, but they can't really go any lower, so they will eventually start rising. The other market drivers are U.S. politics, specifically Trump agenda on tax reform, healthcare reform, and international trade, and geopolitics. This list is just a short list for everything that's going on. But yeah, North Korea, Iran, obviously Brexit, and any other issues of separatism in Europe, such as Catalonia in Spain, potentially Scotland. All of those may be issues for European growth. Cyber warfare, this is becoming a big geopolitical issue as well. So these two, the politics in US and around the world, are basically the biggest unknown risks, and these are your biggest tail risks. So if you're looking at this picture on the right and you're wondering what that is, that is it. That's a visual representation of your big tail risk. So keep that in mind. And then, of course, market themes. So before we talk about the market themes and what we are looking at and what perhaps you should be looking at, we have been recently asked, or I have been recently asked by a publication on how we approach aggressive growth strategies. And the fact is, this is the year to really ask that question, because aggressive growth has been working very well this year. And the way we do this is by looking at market themes. Essentially, we try to find a theme that, in other words, a trend that's working right now. Try to identify companies that are benefiting from this trend, and we build a portfolio based on that, and we put clients into those portfolios for those aggressive growth strategies, where we have clients who follow that strategy. So before we look at some of these themes, let me tell you just a couple of words about our company. So we're Paspon Advisors. We're what's known as a hybrid advisor, which basically means we have a technology platform that does the automated portfolio solutions, but we also have the human presence, the human touch. So it's both technology and people who are working for the clients. And we specialize in thematic and impact portfolios, and this is basically the four quadrants of our success. And this is a typical portfolio allocation process for us. So as you can see, based on a few questions, we can allocate the portfolio, and we also then ask you for specific investment areas that may be attractive, and we build those thematic portfolios that I just mentioned. So what is an investing theme? I did a whole presentation, I believe it was last year on Bright Talk, so you can find a lot more details there, but I'll just give you a quick overview. So a theme is a trend which happens due to economic, demographic, geopolitical, regulatory, or technology factors. So what does that mean? Something happens, new technology, demographic shift, something happening with the economy, new regulations or deregulation, and that creates an opportunity. And some companies are positioned better than others to take advantage of this particular opportunity. And obviously, if you recognize this trend early enough and you recognize the companies that are benefiting from it early enough, you could potentially have a very rewarding experience investing in that trend. So it's been a staple in institutional investing for a long time, but it's usually been very expensive for an individual investor to be a part of that. We are changing that now. We're making it more democratic. We're doing all the research, and our clients can reap the benefits of it. These are just a few theme examples, very broad over the past couple of decades, so you can get an idea. And if you think about things like the internet of the 90s or the search and e-commerce rise or genomics advances in recent decade, and if you think about what potential investments you could have made if you identify this theme early and identify the companies that can benefit from it, you would obviously get an idea of how well you could have done. And it's same for geopolitical and demographic themes. So one other portion in thematic investing that we also specialize in is impact investing, and that basically is an investment that also benefits social or environment causes, as well as potentially bringing you profits. That in itself probably is worth a separate presentation, but I just wanted to mention it here. And this is the difference between impact investing as well as social responsible investing and ESG. So now, without further ado, let me show you some of the themes that have been working and we believe will continue working going forward. What you're looking at is a widget from a company called Motif Investing. This is the broker that we're using today, the company that allows you to build a portfolio up to 30 stocks or ETFs, and it essentially treats it as a single entity, as a single ETF. So saves a lot of money on transaction costs, and this is what we've been using for our thematic portfolios and impact portfolios for our clients. So technological, that's the first type of themes, and obviously that's to some degree that's an easy one. What you're looking at here is a mobile computing supply chain. Essentially, these are all the companies that make parts for iPhones and Android phones and all the other phones, and as you can see, they've been doing pretty well. What you can see on the widget is how the Motif is doing compared to S&P 500, which the Motif is usually in blue. You can see the 1 year return, or if it's less than 1 year, then it shows you since inception, and it also shows you 3 of the largest holdings. So you can see NVIDIA being the largest holding in this one, and if you follow the market, NVIDIA is a company that is at a cross section of multiple different themes and has done extremely well. It's up almost 5-fold in about 18 months. Some other themes here, pay it forward. That's taking advantage of the digital payments theme, and that's done pretty well as well. Oncology clinical. So this is essentially a number of companies that are in clinical stages of various cancer treatments. So the one thing that I can say here, that when we say technological themes, that does not necessarily mean the companies only have to be in technology. It could be a biotechnology, it could be industrials as well, as you'll see very shortly, potentially maybe even other areas. Um, like pay it forward is technology and finance potentially. Technology drives many different areas today, not just the technology sector itself. The matrix revolutions, that is the theme of virtual reality, and I'm sorry about some of the corny names. Basically, we have a little theme, pun intended, going on here, where we try to use fun names that echo some of the movies or songs or TV shows that you probably, hopefully, recognize. So moving on, a few more technological themes. Again, this is a subset of the themes that have been working that we're managing. We're managing roughly 300 different themes, and obviously not all of them are working at the same time, but a lot more are working this year than not. So a few more technology ideas. Smart home. This is actually a sub theme of a larger theme, which is IoT, the Internet of Things. Basically, many interconnected devices that soon enough we'll all have to deal with. Anything that has a word smart in front of it these days, that was pretty much dumb 5 years ago, that is becoming altogether the Internet of Things. And this is the smart home portion of it that's been doing pretty well. Schools out, that's educational technology, also known as ed tech. That I think is the best performing motif for us this year. Is up a remarkable 107%, and you probably wouldn't think of this area as being so good. But there are several Chinese companies that are in there, but there's also a lot of US and European companies as well, and they've been doing really well, as you can see. Game of Drones, hopefully doesn't need any more explanations, and immunotherapy. You can see a little bump there. So these are companies also similar to the oncology that are specifically using immunotherapy and not just for oncology. Kite was one of the companies that was recently spiked and was taken over, and that's probably the bump that you can see there. In the graph that was just a few weeks ago. All right. So what are some of the regulatory and geopolitical themes that have been working and will probably continue to work? Well, let's see the future infrastructure. So infrastructure is a big portion of the plan, part of the Trump agenda, and you got a nice 3.2% dividend yield on top of that. So that theme is working. Managed healthcare plan. So that's part of the regulatory issue dealing with Obamacare, and you can see a little drop there recently. That's when Trump cut the subsidies to the U.S. Health providers and insurers that are using Obamacare. So that's the negative, and that's obviously one of the risks that you're dealing with any kind of regulatory theme. Rising rates, that's obviously a very economic theme. You can see that this is just since April. It's up 5.5%. It's actually lagging the S&P 500 because the rates haven't risen as fast as at the time were anticipated. And the last one, that's an example of a geopolitical theme. R is for rocket. So this is a cross-section of the defense sector that specifically deals with rockets and missiles and anti-missile warfare. As you can imagine, with all the current geopolitical risks, this is really the area where there's a lot of investment in, and this is where militaries across the world, and in US in particular, are investing significantly. So you can see a significant outperformance there as well. Moving on with other types of themes. There is a demographic, and there is a couple of examples here. Young at heart is the boomer generation that is retiring right now. There is some statistics that roughly 10,000 people retire in US daily now. And obviously there's a whole big shift in the economy. And this is not just healthcare, although healthcare is a big portion of this portfolio. And again, you can see a little drop there recently because of the Trump decision to cut subsidies that I just mentioned. But it's more than that. It's financials, it's leisure, it's travel. There's a big section of the economy that is gearing towards the new economy for the big retiring generation of baby boomers. And on the right, you have millennials. Obviously, that's almost a no-brainer. This is the largest generation in US right now, and they have the financial power to make consumer spending decisions. So if you just follow the companies that making millennials their primary target, you should probably be doing pretty well. There's actually a couple of ETFs out last year that are trying to follow the same theme, although our research is probably a little different than theirs. But at any rate, this is since the end of February, this motif is up over 20%, as you can see. And we are getting close to the end. This is the last number of themes that I was going to talk about, and they have to deal with impact investing. As you can see, green transportation, that's being led by Tesla, so no surprise, it's doing really well. But also green utilities. These are utilities that are not polluting as much as other utilities, or not polluting at all. So that's a nice plus. The truly alternative energy. This one is made up of much smaller companies, and there is no solar in it at all. So this is wind, this is geothermal, and this